All right. Are we unmuted?
Probably need to be around 40.
Who's not muted on here? I feel like I hear KT.
Joseph, I think I got it.
Perfect. Awesome. All right, everybody. Well, here we go. We're getting started.
What are we doing?
Kent, what are we doing? What are we doing here? Why did everybody show up? I'm just listen to these two buffoons on the TV. All right, state of the market. So we're doing something a little bit different. I know
Yeah, and
all
I
of
don't
our
know how to
market
turn
centers,
this
we have
up.
about, I think, 5 market centers joining us today, which is awesome. We got 4 in Charlotte. No,
5 in Charlotte.
5
Yeah,
in Charlotte.
My four, you're
No,
1 in
7.
Charlotte, 5. Yeah.
Yeah, so 5 in Charlotte, 2 in Charleston, which is great.
By the way,
All,
you have 3 in Charleston today, 8 that's on here. Isn't that right?
no,
Okay, never mind.
you're in
So
good
we're
hands.
really good at math.
Don't
We're
worry.
doing a lot of math today, so get ready.
Don't
Yeah.
worry. So, all of us do quarterly market updates, which are more on a local level. I know in Kent's offices, you guys do a lot of the nationwide one, which we do as well in person. So we were going to try something different this time. So we appreciate you guys coming and showing up for this. We're basically going to go through the slides that came out from KWRI at the end of April. They're April numbers. They're the May slides. We're going to go through there. We're going to have a conversation. We booked this to 2:15. We're not set on that. We'll just see how the conversation goes.
Yeah, however it goes.
Yeah.
Hey, if you have questions, everybody should have a kind of a facilitator there. Get your questions to the facilitator because at the end we want to answer anything you want to talk about or clarify anything that happens.
Yeah, I think that was the best way to do it. We talked about whether or not having a live audience in front of us, and I know we got one right on the other side of the wall, but I think that keeps it a better experience for everybody in there. So what's the goal today?
Well, anybody can be a realtor that can pass the exam and pay a fee,
Right.
right? And realtors are somebody that if somebody says what's the average 30-year fix today, they can say 6.5%.
Right.
Now you're a realtor. Great. I want you to be the agent expert of choice. I want you to be able to say, well, the average 30-year fix is 6.5. Here's why it's 6.5 instead of where we thought it was going to be 5.9. And by the way, here's what it's going to look like 90 days from now, which is what we're going to tell you in a little bit, because that's who's going to win the business down the road.
Yeah.
The person that truly understands the market and communicates that. So that's just always the goal of doing this so that we have the most well-versed agents out there and that nobody can compete with us because we know this information.
Yeah. So format of today, we're going to go through this. We're going to talk about the economy. This is what I'm really excited about because where I don't like to compliment Kent any more than I have to, he's actually really smart with this economy stuff. It's actually pretty impressive.
Stole it off.
The best part about it is why it's relevant, right? We're going to talk about all these numbers. Why is it relevant to the real estate market? And then as we get in the real estate market, we're going to talk national level, and then we're going to break down, and as a reminder for a lot of us, is what that looks like on a local level so we can translate that to our clients, consumers, and get the message out.
Yeah. So like when I'm talking about nationwide home sales, Joseph's going to give you what home sales look like in the Charlotte metro market and the Charleston metro market.
Yep.
So we'll have the individual for you guys too, as a little added bonus.
All right. So here we go.
Well, and just here, just a thought for you. If you took somebody that graduated with their MBA in 2019 and then put them, in a room and brought them out today and you showed them what was going on, it would make no sense to them.
Yeah,
because we have a lot of numbers that are going to look bad and a lot of that should look bad because these do, and they just don't. We're just not in anything normal right now, which is keeping you and I employed doing market updates.
Yeah.
Well, before COVID, guys, I did 2 market updates a year, and we did the one in February, and then the one in August. We usually said, well, nothing's changed since February. Right. It kind of looked the same, and now it's different every single time we do this. There's just so much going on in the world.
When we talked about that in our Q2 update or Q1 update, we said I actually told a story. My CPA sits on a board for a bank, and he was talking to a couple of other guys that were on there, guys and gals that were on there, and they were talking about the market, and they literally all of them were like, we don't know, right? We can look at individual stats and what's going on here, so we'll have that conversation.
So you just told everybody that we're going to talk,
right?
But that we don't know what we're talking about. So here's the thing: and a lot of times, guys, what we're going to tell you is, here's what it is now, and here's where it can go in the future, and we'll give you the things to look at so you kind of know the direction it's going to go, because that's what you have to have today.
And that was the purpose of adding this, right? Because we're going to do this one this time of year, and we're going to do another one in the fall, and that adds to the ones that we're already doing, so we're not going as far between them. Really more on a national level, because we both live in very transient markets, right? So Charlotte and Charleston are both going to have people coming in, going away, and so they're hearing the news, and we got some stats today that are indicative of people are listening to the wrong sources. So
correct. Yeah. Okay. Last thing before we start, hey, you don't need to take pictures of these slides.
Yeah.
Your leadership has these slides, and you're gonna get them. I know they'll be posted where we normally post them.
Yep.
Ask your leadership where to find them, but you'll get all these slides for being here.
So, all right,
here we go.
We're going to try technology with just two of us. Here we are. And we're not off to a good start.
Share.
I know how to share.
Okay. All right.
Do. Great.
Okay, so while he's doing this, so a priest, a minister, and a rabbi walk into a bar. I don't, what am I supposed to do here?
Yeah,
Are we good now? Okay, all right.
You're good.
Okay, there we go.
Hold on. There we go. All right. Now we're cooking. So, state of the market, we're going to get into the economy part here. So, let's talk unemployment.
All right, so guys, we're going to treat this like the military. We're going to, tell you good stuff first before we break you down and tell you the bad stuff. Despite a lot of the things that I'm going to tell you that are probably not great for the real estate market going forward, this is one of the ones that doesn't make sense with everything going on with inflation that we're talking about continuing to be high, with GDP not having a good quarter. Unemployment should be going up, and unemployment has been extremely resilient so far, and we are still at historical lows. And if you look back at this, if you go back over these years, you got to remember up until COVID, the thought was unemployment could not go below 4%. That 4% is zero unemployment because 4% of the people either don't want a job or are between jobs, right? And we've been below 4% or right above it for a long time. And it, like I say, it just keeps being resilient. And here's the good news is people typically need a job to buy a house. Yeah. And so right now, if you want a job, you probably have a pretty good chance of having one. The other thing that is not shown on here, wage growth has been outpacing inflation most months. Now, we've had a couple months this year so far that it didn't, and that's just something that we'll keep watching. But it's just hard to complain about the unemployment overall.
Yeah. So break this one down a little bit.
Yeah. And one more thing on unemployment. I know in Charlotte, we're having about 3.7%. So we're actually below the national average. We're actually below zero.
Well, apparently. Yeah. Well, both of us. So Charleston's actually at 3% down. And both of us had a drop this year. So Charleston's at 3% down from 4.6 in January.
And in just a second, I'm going to tell you why I think that is. Yeah. So I didn't know that, but I'll tell you why.
Well, Charlotte had the same trend, right? 3.5% is the number I had. So we're within it. Right. But also down from 4% in January.
Yeah. So here's one that I really watched, Joseph. And if you go back not that long ago, we had 11 million job openings at one point, and we had 5.5 million people unemployed. Okay. So that means if you wanted a job, I'd give you two. Well, what's happened is we've seen that squeeze, and now we're at 6.5 million unemployed and pretty close to 6.5 million job openings.
Right.
The closer those are together, the less chance of the skill sets matching up for what we need. So in other words, when there's twice as many job openings, there's a much greater chance. So I just watch this one. You want skill sets to match up so people that want a job can have a job.
Yeah. And that's, let's talk about the job growth historically.
Well, it looks a lot like our economy.
Yeah.
We go up, we go up, we go up, and we take a step back. We go up, we go up, we take a step back.
Right.
And you're just seeing we're may not be at the end of the job growth going. We are still adding jobs to this point and not backing up. And really, if you go back, Joseph, we haven't had a down year since. No, I'm sorry. No. If you go back on this graph, there we go. We practiced so hard on this.
Really good job.
If you go back, we really have not had a decline in job growth since 2008, because you got to take 20 out of there because that was boom for COVID and we came right back out of it.
Yeah.
Yeah. It's been a long, great run for jobs in the US.
Yeah. Yeah. So broken down monthly, same thing.
One little, yeah. Well, and here's the interesting thing, what's going to happen, what was going to happen in March and April, were we going to take a hit because we invaded at the end of February? No.
Yeah.
Jobs have stayed strong.
Yeah. Well, and so same thing. Let's talk about the local market. So in Charleston, the numbers we have for the local markets are what the percentage increase was. So in Charleston, there's actually a 4.1% increase in job growth year over year, which actually ties us for one of the highest that we saw nationwide. Charlotte didn't have as much of a percentage increase, about 2.7% increase, but that was number 2 in overall job growth. Right. So, that kind of proves the point, right? Your unemployment's going down, but job growth's going up. It's almost making it harder because there's less opportunity.
Yeah. There'll be 20 slides I can say this on, but, Where I live is where I was born, and so I'm blessed. The rest of you got here as quick as you could. We live in a great freaking place. We just do.
Yep.
And the industry that we're in to do
100%.
that. Now, the next slide, Joseph, this is what I was talking about. I think this is part of the reason that Charleston saw such a big jump.
Yeah.
Is the second one on there, leisure and hospitality.
Mhm.
Man, there's with plane fares going up. There's a lot more people driving to places, and and I'm not saying this because I'm sitting beside him or I'm talking to half the people here from Charleston. Charleston is my favorite city that I can drive to.
Yeah.
If I'm gonna get my car and go, it is, and a lot of people feel that way. But healthcare continues to drive a lot of the job growth in there.
Yeah. Construction was one we talked about a little bit, especially if you look at the 10-year average.
Mm-hmm.
Look at the drop in construction, which is interesting because we'll talk about new home builds here in a bit. But here's the stat too. I looked up 30% of construction right now, when they're talking about this from a job standpoint, is relates to data centers.
Yeah.
Which is crazy.
Well, and then you take that in there and look at mining and logging, and it's really not logging, it's more mining, and it's because we're trying to mine for some things that we've imported now that are really affected either by tariffs or governments, holding them out on us.
Yeah. So,
yeah.
All right, cool. This is my favorite part because this is where I get to take a little break.
Oh, good.
Because you're pretty smart on this one.
So GDP, so just gross domestic product. I'll give you the brief. The goal is to be at least 2%. We want GDP, and GDP it's the value of all goods and services at any one point in time. It's what it is. You want it to grow because you need growth to support future generations, to support the economy growth. It wouldn't work if milk was $1 a gallon. It wouldn't work for milk to always be $1 a gallon. We need growth to support, as we grow. Now, when we met last time and GDP was looking okay, hey, good, 2.1, we're solid. Well, this is a little moving target. They actually adjusted first quarter down to 1.6. That's not good. Again, that's not a good number. The Fed's not going to like that number. They're going to want more job. They're going to want more, growth in industry as we go.
Yeah.
So that one kind of hurt. But if you go quarterly again, when you're looking at this, man, go back to 2008, and we've been pretty freaking solid for a long, long time. Well, go ahead and say it. 2008, the Great Recession. That's when we hit it. The worst housing market we've ever been in. Since we came out of that, I mean, dude, we're pushing 20 years of some really, really solid stuff.
Yeah.
So it's again, this is I'll give this a neutral. So the job report was good. The GDP, I'll give it a neutral now. Let's see what we do the second quarter.
Yeah.
And see what it looks like.
Yep.
Oh, this one sucks.
Yeah, here we go.
You know what, guys? Here's what we're going to do. We're not going to talk about inflation because it sucks. We'll just skip it.
That's
and
good.
Yeah.
Seems to be what a lot of people are doing.
Well, no, it's all right. So this is definitely the one that's going to hurt us the most is inflation. The last inflation report that came in, if you include everything, it was 3.6%. If you take out, excuse me, it's 3.8%, I believe. If you take out food and energy being high because of gas, right? And we know why that is. And then food being high because you got to get food to the places, it was still way too high, still 2.6%. It's still way higher than the 2% we want. Here's why this number matters. This is the reason that the Fed is not going to cut rates. And I don't know if you guys are paying attention, nobody's even talking about them cutting rates.
No.
So right now, if you look, when the lead economists talk, and they're talking about the rest of this year, when the Fed meets, right now, of all the options, the one they pick is that the Fed will raise the Fed rate one time this year.
Yeah.
And the second highest option is nothing, that they don't do anything this year.
Right.
The third highest option is that they raise it twice this year. So your top three options, you're not getting it reduced. Taking it down a notch is the fourth best option. Yeah. And we went into this year thinking we were going to get three this year.
That's the big adjustment, right? I mean, all predictors, from the first of the year, family reunion and all these were we could expect some drops, nothing huge, which was good because luckily the message we were putting out there wasn't that, hey, rates are going to drop. This is, wait, right? Now we're seeing that not only are they not going to drop a little, they're definitely going to flatline.
Yeah. So everything we've done so far, when we talk about employment, we talk about GDP, we talk about inflation, all this is going to lead us at the end to the mortgage conversation.
Right.
And so just, just hold all this in there. But, Joseph, one key sign to me that they're not going to reduce it is even the Trump administration isn't even talking about it.
Yeah.
They're not even mentioning it. They have the new Fed chief was handpicked by Trump. He's in, and they're not even bringing it up because there's no way when they meet this next time.
Yeah.
There's just no way that they're going to reduce it. I don't think they'll raise it at this point. But I'm going to give you a thought. I'm going to give you a proof of inflation.
Okay.
Okay. If you go back when COVID started, we went from households were saving about 5.5% of their income. COVID happened and it jumped to 11% because they were going to spend money. Everything was closed.
Right.
So you had this personal savings rate of 11%. Well, it's been falling. April of 2025, it had fallen back to 5.5%. April of this year, 2.6%. And the reason it's 2.6% is because it's costing people the money through inflation to spend. They're spending it.
Right.
They can't save it because everything costs more.
Yeah.
Yeah, there it is. It is 3.8.
3.8. So yeah,
Yeah.
have that on there.
Yeah. So
Again, this is the important part too. It's, we're going to keep kind of harping on this a little bit. The job that we have is to explain this to the consumer, explain this to our clients, and do it as if you were your financial planner. If you met with your financial planner, we just, did our quarterly update with ours. And she's like, listen, my job is to explain to you what the risk is. Your job is to tell me how comfortable you are with risk and which way you want to go. Right. And so that's what we got to do with our consumers.
The three things that we just talked about. So I said that that jobs, that's actually a good number for the economy. GDP, I gave it a neutral for the economy. Inflation, I gave as a negative. So you had good news and kind of no news and bad news. That's for the economy. For you, there's no good, bad, or neutral. It's just facts. These are the facts that you play with and that you help people make the best decisions for themselves. And you're knowing the facts. Don't say, oh, inflation's bad. No, this is what inflation is, and this is how it's going to affect us going forward in the market.
Yep.
And here's why this is important. When Joseph goes to the next slide. Yeah. Okay. So it's the lowest ever.
Right.
Since they started tracking it, consumer sentiment is low. Well, and I get why. There is more uncertainty in the world than there's ever been, right?
Yeah.
There just is. There's a lot going on, and we're not getting rid of any of the uncertainty. We're just seem to be adding to it. So right now, I get it. Consumer sentiment is low.
Right.
Deal with it.
Well, specifically, I mean, this one doesn't help, right? This one specifically consumer sentiment with the survey that says, is it a good time to buy a home? This is what we're dealing with, right? 17% down. I mean, here's what's interesting though, look at where it was its high. Well, one of its highest, 2006, 61%, kind of ducked down a little bit in there. Some people were getting smart, but not a lot.
Yeah.
Because that would be the argument to say it wasn't a good time to buy, but no one knew what was going to happen in 7 and 8.
That's true. Well, so the first time I saw this slide, when Gary Keller showed it, and Gary Keller, he looked at Jay and Reuben, and he said, so it says that consumer sentiment is a good time to buy a house, that 17% of the people say yes. And he looked at Jay and Reuben and said, so what does that tell you? And they're like, I don't know. And Gary said, it tells me that only 17% of the people are paying attention because it's always a good time to buy a house, because real estate always goes up in value over time and very seldom goes down at all, even for a blip. And I think that's the message that we have to get across. And, my favorite one, Joseph, that I always tell is the average net worth of a tenant is $10,000. And that actually went down from 11,000 to 10,000. Yeah. And the average net worth of a homeowner is $420,000.
Right.
It's 42 times greater being a homeowner. Yeah. So,
well, I mean, again, it's sentiment, right? And I think it's important for us to know this too, because as we're out, I spoke with one of our teams yesterday at their team meeting, and one of the frustrations was finding buyers who want to or can buy, right? And I think the want to side of it is you just need to prepare. We need to set our own expectations as well as the expectations of our clients and consumers. Part of our own expectation is understanding this is what you're dealing with. Only 17% of the market thinks it's a good time to buy. So when you go out there and you get pushback, don't be surprised. Don't also take it personally. A lot of those people feel that way because they're A lot of those people probably feel that way, aren't buying a home. Like that'd be an interesting one. And then two, they don't really have, I said A and then two. B, they don't really have the right information. So
Do you,
give
hey,
them
you
that
want to start
information.
over?
Yeah,
Or
let's
just-
start
yeah,
from the beginning.
We're going back from the beginning and start over.
So yeah, it's again something to know, but here's what's happening in the real estate market.
All right, here we go. Here's what you guys really want to see. What are home sales going to do? You see the history, we went from 6.1 to 5, and it's been 4.1, 4.1, 4.1. Now, this here says that we're on a current pace for 4.055, and they're projecting 4.3. Right now, there's a couple more months in, the current pace is below 4.
Yeah.
We're actually behind where we've been the last 3 years. Now, Gary Keller from Stage in February, when he's the one that predicted 4.3, and Dr. Young predicted 4.5 to 4.6. Gary said from Stage, but you won't see that to the second half of the year. I don't think Gary was predicting the war in Iran.
No, he wasn't, and it's also, I mean, yeah, he definitely wasn't. So
But by the way, if that miraculously all of a sudden got straightened out and the Strait of Hormuz opened back up
Right.
and everything, we would probably make that 4.344. We would probably get consumer sentiment would go up, rates would come down a little bit, and he would be dead on. But I don't think that's what Gary was basing it on.
Right.
Then I think he was just looking at the other market conditions.
yeah. It is interesting though that he said, I mean, and I can't remember exactly how he said it, but it was along the lines of something will happen in the second half of the year. Will have to happen in order because we won't see it in the first half.
Yeah.
Maybe that something is the conflict gets resolved. Maybe he did know.
Yeah.
He knew about Ukraine.
Yeah.
So
Well, that's true. Well, so here's a two stats that I found. Home sales per 1,000 people are the lowest ever in this country.
okay.
So now we're not selling the fewest homes. We've actually been down below that 4.1, but we are selling fewer homes per 1,000 people than we ever have in history. By the way, is that a bad thing? No, I'm actually glad that we're already at the bottom.
Right.
We can only go. We got to go up at some point.
Yeah.
So we know that we've hit bottom. Here's what I don't like. Home purchase lending last month was the lowest it's been in 12 years. So what that says is they had the fewest people apply for a mortgage last month than they had in 12 years. Now that does not mean we're going to sell fewer homes.
Was that
It's going to lead into it.
was that number few? Was it actual number of people or was it trend from year over year?
No, the lowest it was the lowest in 12 years.
Okay.
Yeah, it was the lowest in 12 years. Now, again, that could point to us selling fewer homes, except for one thing. Historically, about 1 in 4 homes is bought with cash.
Right.
Well, I know, believe it or not, on my team, we're at 55% this year bought with cash. Now, I'm not saying that that's normal for everybody. I just think there are more homes. And by the way, it's not always their money. I know that we had a client on the team that was looking up to 450.
Right.
And they had the loan approval and everything. And they called and they said, hey, we want to move our search up to 700. And they said, well, we're going to need a new approval letter for that. And they said, no, our parents are going to buy the house. And then they are going to do the loan with us. So that's actually a cash purchase that went through. And that, man, if you live in California, 18% of homes that trade in California are passed down to a generation.
Yeah.
What if you lost 1 in 5 houses and you didn't get a chance to sell them because they're just going to give it to somebody? That would not be good for your business. So another reason not to move to California.
Well, yeah, one of many. Yeah, and I was just looking up again and confirming. It's about 18 to 20% in both Charlotte and Charleston as far as cash deals that come out there. So yeah.
Yeah, so you're actually a little bit below the national average, but I don't know. It's just something to watch.
Yeah.
And here's what we were talking about. If you look at this every single month, I guess April we were just up a little bit.
Yeah.
But we're just a little bit behind, where we were last year.
Yeah.
It just continues. But hey, that's the national. Tell me about the local.
Yeah. So well, let's jump into the local. So we've seen this before, right? We saw what was happening in Charleston. It's really kind of a flat line. So it's a small increase, right? Increase of a couple percent. Actually less than 1% that we had in there. So again, here's the thing to keep in mind. We look at it from a trend standpoint. We got to look at all these numbers from two different vantage points. Number one, for a trend, so we know how to kind of see what the market's going on. We also have to look at it from a business standpoint. I mean, at the end of the day, in Charleston, there's still 2,800 homes that sold, right, in a quarter. So you've got you've got almost 6,000 sides available.
Enough to make your goal.
Enough to hit your goal.
Yeah.
There's not a person on this call who, if they got their fair share of that, wouldn't be able to hit it. Charlotte saw a little bit of a different, right? Charlotte saw a little bit of a drop, about 6%, 5.9% drop, 5.8. That was something that raised an eyebrow, right? We were looking at this saying, okay, in Q1, we saw a little bit of a drop there, especially when you've got all the other signs pointing towards positive in there. So we're going to keep an eye on kind of how that turns out in Q2. But it was a slight drop on all parts there, and I don't.
In a minute, we're going to talk about affordability, and I think Charlotte's getting affected more by affordability than some places are right now. But we'll talk about that. And guys, just so you know, whenever Joseph says Charleston, he means the greater Charleston area that covers however many counties.
Yep.
Same with Charlotte.
Tri-county
The Charlotte metro for us, it's Mecklenburg and all the surrounding counties there. So this does apply specifically to you.
Yeah,
as you went through.
100%. So that is, I mean, we just keep an eye on it. Again, same thing applies. In Charlotte, you had 6,300 closings, right? So there's 12,600 sides. It's enough to hit your goal, right? We just got to figure out if we're not getting our goal on that, we need to be adjusting who we're talking to.
So I did take more listings in Cornelius yesterday.
Okay.
And one of the things that they kept saying was take your unfair share.
Right.
While I was sitting there, because, of course I have all my numbers, and I went and pulled, and in 2021, the market did go up in 2021 when we sold 6.1 million houses.
Yeah.
I think it went up 18%. I went up 30% that year. But then the next year when it went down 18%, I went down 20%. But then while that market went down again, and then even, my percentage has gone up every single year. And the highest percentage increase I've had is year to date this year.
Yeah.
In my business. And it's just because we're just focusing on what matters.
Yeah.
How are we going to get the most appointments out there?
Yep.
But when the market turns, everybody typically takes a hit because nobody's prepared. We're never prepared for it.
Right.
Those that get out of it the quickest are the ones that comes through.
So, all right, home prices.
Again, I call it flat.
Yeah.
Now, when you look at home prices overall, in the West, home prices are actually up a lot. And they're kind of counteracting some of the rest of the country. And it's just because right now so much AI is based in San Francisco and out West. It's driving those up. It's also prices are up in the Northeast. In the middle of the country and the South, in a lot of places, prices are actually down this year. But at the end of the day, it's no more, when you look at places, it's no more than +2 or -2%. Yeah. It's just a really flat line. And what that's doing, that's getting us more in line with historically where that average 4% trend line should be. We keep getting closer and closer to it each year on where it is.
Well, and I think the challenge, and then again, everything's about perspective. So if you look at the last 6 years, almost 8 years now, no, 6 years is a good one. You look at the last 6 years, you saw such a spike, and let's be honest, we're our worst enemy sometime, right? You've probably got 80% of the people listening right now got into the business in the last 5 years, 6 years.
Sure.
So you saw this big jump, and now that the jump's not as high, and we've actually got this broken down over time on what it is, that's what causes the pain or perceived pain, right? Because you think that the market's not good. And this is why it's so important when you're talking about a buyer consultation. What are your buyer's plans? If it's to be here for 18, 24, 36 months, I don't know if buying is going to be the best thing, right? I mean, unless you can hold on to it and want to go for appreciation.
Exactly.
Like, we need to be thinking about the long game on this, right?
So, and go back one before you go, just so you know, and I'm glad that there's all realtors on here. And if you invited a lender today, don't let them say bad things about me. But if you look back in 8 through 16, when we fell below the line, that was caused by the mortgage industry. That was taking loans that they probably shouldn't take. Right. And then if you look at the big increase, I shouldn't blame this. I'll blame that one on the government because the government let the mortgage industry give 2.75% interest rates, which then everybody wanted to buy a house, which they should. I wish I would have bought more of them, actually, looking back on it. And so that is a function of the mortgage industry on both of them, with the government being a big influence on one of them.
Well, and I think that what's interesting, if you look at these, the correction is the quote unquote correction. If you look at 2019, let's see, 2020 to 20 now, the correction, so to speak, is not as drastic. Right. No. And I think that's better. I mean, you look at 4, 5, 6, and then 7, 8, 9, holy cow.
Yeah.
And we're not really seeing that. And that's a big thing. And that's the one thing that's kept it going for this, is it's really becoming more economy driven versus just bank driven.
And by the way, anybody that thinks that we're heading towards something like 2008 has lost their mind. We're not. First off, there's not enough listings to go through that.
Right.
if you go back and we were looking at homes sold, and you go back to when we were selling just over 4 million homes the last time, there could be 7 million listings at any
Yeah.
one time, not 1 million to 1.5 million like we have now.
Mhm.
And then if you look at the percentage of water, we're actually still houses that are in pre-foreclosure or foreclosure are still below the long-term average. We haven't even got to average yet, and it's really, really small.
Well,
There's not going to be a housing market collapse.
Well, and again, that brings up a good point because what we've got a handful of short sales more so than I thought we'd be talking about, in the last couple of months. The banks aren't doing what they were doing back then.
No.
The banks aren't being like, just take it. They're fighting for fair market value.
Sure,
So you've got
they should.
it's a house thing now. It's not a value thing. You've got to love the house to stick out a short sale because you're not doing it because you're going to get some great deal on it.
No,
And
not at all.
that's helping that and the fact that there's not a lot of them yet. So
But we're not going to crash.
right.
Might be tougher.
Yeah. All right. So monthly.
Monthly,
That's what it looks like.
yeah,
We'll talk about this
it's
on a local level more
and,
than
and it's funny when a lot of these when you see them, but right now they're getting one of the biggest discounts we've gotten since COVID
All right.
in terms of what they're getting off the property.
Yeah.
The median can be in the high 390s, whereas it is 418 is what they're listed at, right?
Right.
So
Yeah.
it's just interesting. Again, that's a pretty flat line, and now you're going to give.
Yeah.
It might look a little different than when we talk local, though, right?
Well, it's interesting. So if you look at local, so we'll start with Charleston. So if you look at local, obviously we look back in, COVID time where it was a big, jump that happened in there, that 450. But again, it's trending over time. This is a perfect example of why real estate's the long game. And what was happening is so many of us were looking specifically in that mid 2000s to 2000 and, 2020 to 2024, 5 now. We're thinking, oh my gosh, it's flatline. We were talking about this morning. I mean, my house, that we bought 2.5 years ago, a lot of new construction in there. We're not, if we went to put it on the market right now, we wouldn't be excited about it.
No.
Right. But I mean, that's not why we bought it. And our neighbors who just sold, they're fine with it because they were one of the first ones in the neighborhood. So they did fine. So that's the part we got to keep in mind. Again, the long game. This next slide's pretty interesting. Well, here's Charlotte. Charlotte, same thing, right? We saw the spike back in 2020. We saw the same thing, a little bit more of a flat line now we're seeing in there, the seasonal side of it.
And by the way, Joseph, I like a flat line on prices, especially as interest rates stay up. I don't need values to go up a whole lot
Right.
until we get some relief on interest rates and we get more in line, because we're going to get to affordability in a minute. And
Yeah.
that is affordability is those two things.
Yeah. This is interesting because this breaks it down by quarter. And this was the change in median sales price quarter over quarter. I think the reason this is interesting is it helps give perspective of why people are thinking the way that they are. Because if you took out that spike from 2020 to 2024, or excuse me, 2022, and you just had the trend lines we're seeing right now, nobody would be as alarmed.
No,
because
Oh,
you're
and
seeing
by the way, it did go up every quarter.
it did go up every quarter.
Hey, Joseph, has your business gone up every quarter over that period?
Yeah.
No, it hasn't. I know it hasn't. You've had. I mean, I'm talking in our
Businesses.
offices,
Right.
And,
Oh, yeah,
my
yeah.
team. It doesn't go up
No.
every single quarter.
Yeah.
That's not
It goes up
typical.
every quarter.
That's not typical in the business world, but in the home ownership world, it is. It's not unusual for you to see long periods of every quarter. Then you might have a small downturn, and we've got slides that can show that man, over time, real estate is an outstanding.
I mean, but look at
investment.
that. In 2022, Q2, 22%. That's huge, right? That's huge. And what's happening is you saw your neighbor do that, and now you're only seeing 5% and you're upset about it. It's like, well,
But the thing is, you got the same 22% jump then.
100%.
Exactly. You made it.
Exactly.
Yeah.
So
Yeah.
Charlotte, same trend. A couple small dips, right? There in 2023, but for the most part, the trending is what
Same,
it is.
yeah.
So, all right, affordability. You keep looking at your watch. I'm looking too. Don't worry.
No, we're good. No, we're good on time.
All right.
But I don't want to talk about this. This sucks.
All right. So we'll go back to
Yeah. All right.
this
Well,
here's a tough one.
You've heard the expression, I didn't know how good I had it,
Right.
so I didn't have it anymore.
Right.
We didn't know how good we had it because we had that run of affordability being amazing from starting in about 2009.
Right.
It went down and it stayed all the way through the COVID, man.
Yeah.
And 17, 18%, lowest in history. And I remember, here's what I remember is that I wasn't talking about it then. I was not talking about how great affordability was. I didn't start talking about how great affordability was, so it wasn't good anymore. And that's when I realized, well, damn, we had it good.
Yeah.
And now we don't. we're even above the trend, the historical trend line of 27%. Last year we were in that 33% on affordability. But at the end of the year, we started getting some of it back. And it actually fell as we got to the end of last year, beginning of this year,
Mhm.
and it was getting really close to the 30. Anything under 30, I'm pretty good with, right? 30 and under. I mean, we were right there above that 30, and then the Iran war starts
Mhm.
and interest rates go up. And remember, affordability, guys, all that is the price you pay and the mortgage rate that you have. Now, how much, in other words, how much of your income per month goes to principal plus interest? That's what this chart is. 30 we can live with. 40 gets disastrous, man. If it goes to 40%, you're gonna have trouble selling anybody a house.
Yeah.
But we didn't like the 32, 33. We saw it coming down. Interest rates have gone back up, and although prices are flat, that's caused us to be back in that same 32,
Yeah.
33%. That can be different where you live.
Yeah. Well, I think this is why it's super important to just understand what you're doing when you're paying a mortgage payment and you're buying a house. Because yeah, it takes 32% of my income to purchase now or to live now. If I do that in a house versus renting, this is where we had this other, how do you get over the rental objection? Well, this is it right here. This is it. If you're going to put your money towards housing, put it towards housing where your mortgage is having a large portion of that payment's buying equity down, including what we've seen, appreciation over time.
Well, what all you're doing, so if you're renting, you're just giving money away. And I get, well, my rent's going to cost me 20%, and this is going to cost me 32%. But if you look at it, so part of that money that you're paying, and your rent, that's all gone. But part of the money that you're paying,
Right.
you're getting back, you get to keep.
You get back.
Yeah, and the value of that property is going up at the same time. So
Right.
now you're getting more back. And I basically just locked in my rent for 30 years.
Right.
Yeah, I mean,
That's the big one.
Yeah, I just locked it in, and because I guarantee you, rents maybe will tick down, and they actually have. Like in Raleigh and Charlotte, the rents are maybe down just a fraction,
Yeah.
but over time, rents go up just like home prices go up, and you're locking it in, and it just goes back. Average net worth of a tenant, 10,000. Average net worth of a homeowner, 420,000, 42 times greater. Why not
Yeah.
lock in that forced savings account?
It's a forced
While you
savings.
can.
That's exactly what it is.
All right, here's the bad news. So man, this is a new one on me. In 2019,
Mhm.
the median income it took to buy an average house, $79,000.
Right.
Okay, that was the median income. Today, it's 146,000 median income to buy the average house. That's a huge
Yeah.
number in 6.5 years.
Well, this is what
Giant number.
This is showing that.
Well, it's because of affordability.
Yeah, it's what this is showing that right there.
But
It's
just
a
to
big
tell,
jump.
but so I'm saying it used to be 79,000. Now it's 146. What did you say? If you were considered low income?
I saw an article. I should probably verify these numbers, but I saw an article just came out in Charleston. They were saying that I think below $67,000 a year in the greater Charleston area was considered low income.
Was considered low income. So by the way, if you're a teacher and you're married to a teacher and you both have a full-time job, you could still be low income.
Right.
That's, by the way, that is sad.
But yeah, and the context of the story would be interesting too. But it's it's just their affordability is there. I think the message though, and here's the deal. Let's not even talk about the message to our consumers. The message to us, because this impacts us as well, right? The message to us is A, we can change our income, right? I mean, we can go increase it. And B, change your perspective. If you're not investing right now, if you're not putting money in the market now, you're missing, yes, it costs more, but you're missing the opportunity to build wealth long term.
Yeah.
At a high level, a really high level. Monthly.
No, but that just shows
yeah.
where it went down and now it's going to start going
Yeah.
back up.
All right, inventory.
Well, okay, inventory. I mean, this is actually good news that inventory continues to tick up. And inventory is, you can see it's a little seasonal in there, but it is ticking up a little bit, but it's not a lot. Now, I do think, Joseph, in the past, we've talked about a balanced market.
Mhm.
You either said a balanced market was 6 months of inventory,
Yeah.
or you said it was 5 to 7. Either way you say it, we're supposedly not balanced. I think there's a strong case to be made
Mhm.
that 4 to 5 months inventory is the new balanced market, and
Yeah, I
not
agree.
6.
Yeah.
And so we're actually closer to a balanced market than we think we are.
Why is it good that inventory is going up? If I'm a seller and I want to be more competitive,
Well, if you're a seller, maybe it's not good news.
right?
I'm just talking to real estate agents. And if I'm a real estate agent, I would love to have a balanced market all the time. Here's the thing, as a real estate agent, you never have a balanced market because it's a pendulum.
Right.
It's a seller, it's into the seller's advantage, and it swings back, and it just does it. And you're never in that market for longer than than
Yeah.
an instant. But we just want a balanced market. I mean, if we have the same number of buyers and sellers, give me the same number of buyers and sellers and give me it's a 6% mortgage rate all the time, and this would be a really easy job. But then
Right.
we'd have even more people trying to do it
Yeah.
than we do. So just be thankful we have. Now inventory, Joe, here's an interesting one though, and here's what could hurt us on inventory coming up. And this one shocked me of all the numbers that I was pulling for this. In April, 6% of all homes that were listed were withdrawn. 6% were pulled off the market. That is the highest since March of 2020.
So, yeah. So every 100 homes that are off the market, six came off.
Six said, you know what? And then they're like consumer. I see that people are not confident in the economy, and I see that mortgage rates are high, and I see that days on market are up. And you know what? I'm out. I'm gone. That's it. And think about this. Right now we are in, and seasonality is not as big as people want you to think it is,
Yeah.
but we're in the season, man. Right now is when I mean, if you were going to keep your house on the market, April would not be one of the months I would pick to pull my house off the market. Yet 6% of the people did, highest number since COVID started. To me, that's a big deal and definitely something to watch.
Yeah.
And does that start to affect
That was nationwide.
That's nationwide.
So
Yes,
on a
sir.
local level, I pulled this up. Here's what's interesting on a local level. For every 100 finalized listings, 27 failed. So it's actually 27% that are coming. Now that's total, right?
Yep.
They come over
Failed because they were drawn or the
withdrawn
contract
or
fell through.
expired. No, withdrawn or expired.
Okay, but that's over the course of the listing. This was just if you started the month
So they
with
started
100,
and-
yeah,
Got it.
exactly.
Okay.
Yeah, that'd be the difference.
That makes sense.
But now Joseph's telling you more than 1 in 4 ultimately will fail right now. That's
Well,
a lot.
It is a lot. And what's interesting is if you look at the home, and by the way, this is what you look at from an opportunity standpoint as an agent. If you look at homes that actually sold, you had roughly almost 40% of the homes that sold in Q1, and it's right around 41%. It's about the same in both Charlotte and Charleston, had been listed before.
Yeah.
I mean,
the perfect example, we went to a house, we got called, it just went off the market, had been on the market for 6 months,
right.
was listed at 529.
Yeah.
They actually were not that far off. 529 was just a weird number because you're missing anybody that was searching up to 525. We went and we said, if you put it at 520, your ultimate sales price is between 505 and 515, and you'll get more showings. In 6 months, they had 3 showings. In the first weekend, we had 3 showings and we sold it and we closed it today at 510, right in the middle of that five. But it's because we knew what we were talking about, we knew what we were doing.
Yep.
And he didn't like because the previous agent told him I'll sell for 525. He put it
Right.
at 529, which again to me didn't make sense. But in the end, what we told him turned out true. By the way, it appraised at 510.
Yeah.
So the appraisal was right on where we were.
Yeah. And it's about setting the expectations.
100%.
I mean, that's just it.
And knowing your market, you got to know it.
Yeah. So a local level. So let's take a look at Charleston. We're seeing basically the same thing, right? We get a spike in January. We're seeing that kind of curve over time of what the inventory looks like. Saw it over the last 2 years. Sharp jump in January, obviously, to go up for Charleston. That was kind of interesting and not quite as sharp in Charlotte, right? It's a little more smoothed out, but the same concept applies. So that's, we're seeing the same thing here. Inventory taken up from an agent standpoint. That's good news.
Yep.
Right. All right. Mortgage rates. Everyone wants to know.
I don't want to talk about this one either.
Well,
All right. And by the way, do not use this slide because it's wrong.
right.
I mean, this is the one from the beginning of the year where we felt like, as we came into the year, we were just over 6.25, but it was going the right direction. On February 28th, we actually hit that Friday ended at
Right.
5.99.
Yep.
Is where it ended. It actually ended the day under 6. We invaded Iran on Saturday, and we woke up and it was 6.35 on Monday. It's bobbled up and down. Right now, we're on kind of a couple week run. It's roughly 6.5 is where it is. Where's it going to go? Might not go much of anywhere. We're really going to have to watch it. So here's the things. If we keep losing confidence and that 10-year treasury continues to go up, interest rates will go up. That 10-year treasury. If the Fed raises the rate because of inflation, mortgage rates will go up. If we can get this war behind us and get the Strait of Hormuz back opened, rates will tick down. But do not get excited. Even if we get the Strait of Hormuz opened, they're not going to go down a lot. And I'm going to give you two reasons. First off, there's going to be a long time for us to get back to normal, for us to get the oil back where it's supposed to be and everything. That's going to be a month's project now to get it.
Mhm.
And the other thing is, if the Fed doesn't reduce their rate and the 10-year Treasury doesn't come out, it's not going to be enough. I think best case scenario, we could get down to 6.2
Right.
this year. I think we're just as likely to go back to 6.75. And it's just a coin flip right now.
Right.
You just don't know. But this is why you got to watch the news and watch what the Fed's talking about, watch what the 10-year's doing, and keep track of the Iran war and what's going to happen there. Ultimately, historically, 6.5 ain't terrible.
It's not.
It is. But if you've got anybody sitting down saying, well, I'm going to wait until interest rates come down,
Yeah.
they're wrong. Here's some good news, Joseph. You know that we just passed a couple months ago. Right now, there are more people in this country that have an interest rate over 6% than there are people in this country that have an interest rate under 3%. Okay. So
perspective's a little different.
Yeah.
For sure.
Well, it does now. Half the people that have a mortgage are still under 4%.
Right.
So there's still a lot of people in that 3 to 4 and 3 to 5. But there is, and every time you sell a house with a 6%, that's just takes it gets us a little bit further away from those artificially reduced rates that we had that we will never have again. Because if we do have them again, something's wrong, and I don't want to be around for it.
Yeah. Well, I mean, the wait game here. If I've got somebody who says that I'm going to want to wait, I mean, I'm going to show them this chart.
Mm-hmm.
And say, okay, if you wait, the unpredictability of this, and then I'm going to go back and I'm going to look at this chart. And I'm going to say home prices, like here's what we know. If you wait on mortgage rates, we don't really know what will happen. We've got indicators. If you wait on home prices, this is what we know is going to happen.
Mm-hmm.
Like we're going to see them go up.
Well, in 1971, if you would have said, I'm going to wait till rates go low, they were like at 7.2, and you said, I'm going to wait till rates go down, you would wait over 20 years.
Right.
They said over 7 for 2 decades,
right,
and never went under it. The waiting game is not is not. Well, there it is in 1972, and you go all the way. Look at that, all the way up to 93, 21 years. But if you said I'm going to wait till they go below that mark, you would have.
Well, if you waited at that point in 73, if you waited for 8 years, you're at 16.
Yes.
Right? So
yes,
and you're definitely waiting after that one.
Yeah.
All right, new homes.
All right, I don't understand it, but the new home market is really resilient. There's a lot of reasons for them not to keep building houses.
Yeah.
Now they have gone up and down a little bit, but the stats that we were hearing this week is actually new home sales are up.
Yeah.
They're up
3.3% year over year, and then 7.5% February through March. That's, I mean, now it's definitely outpacing
they are. So new home now, and keep in mind, the big advantage that they have over our existing clients is that they can offer better interest rates.
Right.
That's the biggest advantage. The second one is they don't have to make as much money per house. You know what? They got a lot more flexibility. They just have a big advantage. But I like the fact that new home construction is a viable option. Now, I did see this. New home prices are down slightly this year from last year, but also the size.
Yep.
Yeah, price per square foot probably hasn't changed a whole lot. What they're saying is, guys, we're going to back up how big of houses we're building by just a little bit to bring the prices down a little bit and offset this interest rate.
Fairly substantial. Like they were saying, that went from an average of 2,700 square feet to 2,400 square feet. So, again, I think people are revisiting what they're buying and what they need. The other factor that's taken into it with new homes is there's 50% of the transaction has zero emotion.
Oh, yeah.
I mean, it's take it or leave it. There's nothing that's in there. So
exactly.
That helps on that for sure. So broken down annual.
Yeah, man, we've been good for a long time. That thousand a year is just where Gary's just always said, when it came to our inventory problem we've been in for so long, he said new home starts is never going to get us out of it.
Yeah.
But if they build 1,000 homes a year, they won't contribute to it.
Right.
That's all I want is 1,000. And there you go.
So, and then this is always interesting because your sales and your starts don't always match.
I keep saying 1,000. They know that we're building more than 1,000 houses. It just says 1,000 on there.
Yeah.
Okay, good.
Get that one.
Thank you.
So
Right.
Sales monthly again, kind of trending the same way. They're actually the sales side of it's a little flat.
Well, and just keep in mind, guys, in case you've never been to one of these before, the reason that the sales is so far below The starts is because starts is by permits pulled. Sales are by things in basically an MLS
Yeah.
that weren't built for somebody or
Yeah.
built,
I mean,
built
you
to
can see the
rent
big
or
one on this
something.
one, your sales were, or your starts were at 1,000 and your sales were at 670.
Yeah,
You know,
yeah.
think
And
that'd
that those don't worry. They do sell all the homes they build. All the new construction
They do.
do get sold.
No.
They're not just sitting out
Yeah,
there
that wouldn't
somewhere.
worry.
Yes.
Here's that many to worry about. All right. Anything else on new homes?
Nope. Then we're good.
All right. Oil prices and mortgage rates. Here's where we are.
It just is. You've got the big spikes. When oil prices go up, it causes inflation to go up. It causes people to start betting against the market, which means that they invest in treasuries, which in turn makes mortgage rates go up.
Yeah.
It's just a simple way to put it. We need the price of oil to come back down. To do that, we need supply to go back up. To do that, we need the war to end and the Strait of Hormuz to open and get us back into a more normal market. It hurts at the pump.
Yeah.
It does.
There's nothing quite as alarming as when the pump shuts off before your tank is full.
Yeah, well,
I was like, I think I need a little more. Yeah.
But it depends. And if you haven't experienced that yet, gas stations set how much gas you can put, but just because I think they're worried that you stole somebody's car, right?
Well, yeah, it was a number. But
there's a number.
$100. I was like,
So I've been to the
not bad,
hundreds.
it is.
Yeah. I mean,
not fun.
and if you drive a diesel,
Yikes.
get a bike. Yeah, because the diesel prices are I saw where your full-time long-range truckers
Yeah, you were saying
are spending $400 to $600 more a
a
week
week.
in fuel
Yeah.
than they were before that.
Yeah.
That would hurt. Again, that we need oil prices to go down and eventually when oil prices go down, mortgage rates don't go down that day. But I promise you, oil prices going down will have a positive impact on what we're doing.
Yeah.
Yeah, so a lot of people know that one of the things that I like the morning brew is of all my daily emails, the morning brew is my favorite. And it's because at the top it tells me what the major stock indexes have done, and it tells me what the US Treasury has done, the 10-year Treasury, right?
Yeah.
And I follow that because typically there's about 2 points between that 10-year and where mortgage rates are.
Yeah.
And if you look at it, go back to when we were at 3. Well, look where the US Treasury went to. It went all the way, down there. Yeah. I mean, it just went, way down below 2%. That's why I watched that one. I look, what's the 10-year Treasury? Add 2. And I probably can tell you what that day's average 30-year fixed is. It just kind of stays typically that close, especially long term. It might fluctuate, before and after, but
Yeah.
to me, that's an easier one to watch than worry about what the Fed's going to say every 6 weeks.
Right.
Because that one comes out, every day. All right, here's where it is.
Yeah.
What do we do? And this says 4.21. I think when I looked this morning, it was 4.6.
Okay.
And interest rates are 6.5 roughly on a 30-year
up.
fixed.
So still tracking.
Funny. Yeah. Isn't funny how that works?
Yeah.
Yep.
All right. So what did we not cover?
I probably have to ask them. Here's the thing. I think anybody that just listened to what we did is going to be the smartest person at the cocktail party this weekend.
Right.
They might not know everything, but I guarantee they know more than everybody else about the economics of real estate. And
Yeah.
if they're able to talk about that at a high level, whenever that person does think about buying, selling, or investing in real estate, they're going to think that you're the smartest person in the room.
Yeah. So if you guys have questions, if you want to let your facilitator know, we can type some in here. But
by the way, I am the smartest person in this room on that guy with real estate because there's just me and Joseph in here. So
yeah,
there you go.
Yeah, you're strategic on who.
Yeah, very on who I invited in. Yes.
Yeah. So how do we use this information while they're coming up with questions, if they have any? How do you use this information with your business?
Well, there's 2 ways. First, internalize what we talked about today. And know how to talk about it. The second thing is you've got access to these slides now.
Yep.
Like your leadership will tell you where to get them.
Yeah.
Some of these might need to be in your listing presentation. They might need to be in your buyer presentation.
Yeah.
But just learn how to talk about them.
Yeah. Where do you go? I mean, you've mentioned a couple sources, right? I mean, I know that we're the best source for many of you, and I'm sorry for that. In the event you needed to go to more, you said the Morning Brew.
All right. So here's where I get my information. These are I'm going to give you 3 daily emails: the Morning Brew, Daily Valet, and 1440 Daily Digest. Those are the 3 that I get every single day.
Same again. Morning Brew.
Morning Brew, Daily Valet, 1440 Daily Digest.
Okay.
Okay. So there's three, they're free.
Okay.
You just sign up and they're my inbox. The fourth thing would be is called the playbook. And the playbook is done by the Morning Brew. It comes out on Fridays. But the playbook is all about real estate. I don't know why they call it playbook, but it just, it recaps and it gives you current days on market, current inventory, current prices, and current mortgage rates. Very first four things it covers. And what I like about it, it says we're here today and we were here last year. By the way, last year, mortgage rate 6.8. 6.5 doesn't sound so bad now when you think, wow, a year ago it was 6.8 still.
Yeah.
Yeah. So I do those. Every month I listen to the Keller Williams Market Update.
Yeah.
We listen to that podcast, and that's Ruben and Gabby do that. And then, if you really like what we just did, the TNT Business Podcast,
Shameless plug.
KT and I do that. And our most regular guest,
I don't know if that's a selling point. For but I will
nobody
say,
from Charleston is going to listen now.
That's right.
But we talk about the market a lot. And by the way, if you want a recap of this in a little shorter version, next Wednesday, the TNT podcast comes out every Wednesday. KT and I will go through these numbers as well. So you have another resource you can go back and listen to.
God, I'm so glad that I get to promote your podcast.
Isn't that great? Yes, it's awesome.
Yeah, the Housing Wire is a good source too. They've got a good, it's like a 12, 15, sometimes 15, 20 minute. They do it daily actually. Got some good stats in there. You got to filter through it. All right, so you see the question Jan's got.
So
we blow it up.
So does Kent only share, or do you look at the 2.5? So I only
What
look.
was the question?
Oh, I'm sorry. Thank you for She said, do you only look at the 10-year or do you look at the 2.57? I really only look at the 10 because that is the one that represents the best, that long-term look. Now, you might be way smarter than me, and you maybe can look at the shorter ones and digest some information out of it. But the 10-year is the one I've always been pointed to.
Yep.
I do like Mount Pleasant said they have no questions because Joseph was so well spoken. Which, by the way, somebody's going to ask for a raise today.
Yeah, it's like
in Mount Pleasant.
There's a bill coming for that one. So here's the deal. We'll go for a couple more minutes in case there are questions. Use this information, right? There's, the entire purpose in our business or entire way to build our business is having conversations with people and providing value. And we've got in here however many slides. Some of them you can explain well, some of them you can't. Go back, watch this, share this with your consumer, or use this as an opportunity. Absolutely copy everything that we did and start making your own clips from this, right? Make your own content. I'm not talking about being a content creator, but you want to get in front of people with some valid information and valuable information. Use this.
Now, the reason I'm laughing is Joseph just gave you permission to steal our material.
Mhm.
And I'm laughing because we stole all this from somebody else. We don't come up with this. It's all we steal the slides from KW.
Yeah.
And from wherever you get yours, you got
Chartmasters. Yep.
from Chartmasters. So we steal their stuff. Now we do some research around it,
Right.
but I didn't go and physically find out what the inflation rate was. The government told me. I just go and pull the number.
Right.
So please steal all this because we stole all of it ourselves.
Well, the important part is the conversation around it, right? Lindsay's going to appreciate that. The conversation around it. And are you having the right conversations around this? And that's hopefully what you'll take from this is, again, if the two of us can have a conversation about it, you can as well. And it's about, Vince always says it's like taking the complicated and simplifying it. He says it's much better than that. That's all you need to do is take this information that's complicated and simplify it for the consumer.
No questions?
Tell you what.
That either means that I know my university office, they're going to a bar after this.
Yeah, they close.
So I know why university has no questions. They're like, please, they're cheering. Please shut up is what KW Unlimited is saying. And then everybody else, you fed your people pizza for lunch. They probably fell asleep during this.
Right.
I don't know what
Not
my
everybody
people ate.
pizza. God, put the gavel down.
All
right. Appreciate you guys. If you need anything, please reach out. You probably have tacos in West Ashley.
Tacos in West Ashley. There we go.
I'm on my way.
See, we mentioned food and people start putting things in the chat.
Now they're talking. All right. Thank you.
Thank you, guys.